makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. President Biden is set to unveil sweeping tariffs targeting Chinese EVs and strategic sectors with an announcement possibly as early as next week. We'll bring you that Bloomberg scoop. Britain bounces back from a shallow recession with the strongest growth in 2.5 years. Meanwhile, the BOE leaves the door open to a June cut. My interview with the Governor Andrew Bailey coming up. Plus, the Prime Minister Benjamin Netanyahu says Israel will fight on in Gaza with or without U.S. support as Washington threatens to withhold more bombs if Rafah is invaded. So we have a lot to get through, a lot of geopolitical, of course, tensions across the board. If you look at European markets map, they're kind of edging sideways. Now, a lot of the focus will actually be from the U.S. Here in the U.K., we did have better than expected GDP data, or certainly the U.K. economy bounced back from a very shallow recession. And, of course, pound edging higher on the back of what we heard from Governor Bailey. So you can see sterling 125.27. A couple of other things we're watching out for is really treasuries. So I would keep this at the forefront of your mind throughout the day. We have many Fed speakers ahead of that really important CPI number next week. We hear from Michelle Bowman and Neil Kashkari. Again, any clues about the timing of policy easing is something that a lot of these markets will want to know. And then the focus in general is what the Fed does in the coming weeks and the coming months. CPI next week. We have a number of events that we want to cover really well next week. But, of course, CPI left, right and center. Now on to a Bloomberg scoop, and Bloomberg has learned that the Biden administration is set to impose tariffs on China EVs and other strategic sectors as soon as next week. Well, the move follows a review of tariffs first put into place by the Trump administration. So let's get more now with our Craig Trudell, our Bloomberg Global Autos editor. We thought, Craig, waking up to the news that actually there were EVs and tariffs, that you were the perfect person to first of all try and understand the difference between what the U.S. is doing and Europe is doing. But actually the Biden administration is going pretty strong on this. Yeah, I think this is a case of the U.S. being a little bit out front in terms of targeting Chinese EVs. And the European Union playing a bit of catch-up in October of last year, opening an anti-subsidy investigation, which, by the way, will in all likelihood result in some additional tariffs to be introduced as soon as or by July, at least on a provisional basis. So I think this is the case that we're seeing a general sort of move globally at this point of concern in the sense that, China has become last year the largest car exporter, and EVs being a big part of that and being the sort of future of the industry and something that the rest of the world is concerned about, that becoming, a trend with real staying power. But, Craig, so what does this mean for the China EV makers? Because actually there are many, many of them, right? We were going through the list, I think, when we saw each other a couple of weeks ago. I mean, there are many of them, and they're really subsidized by the government. Yeah, I think the EU investigation and the sort of impending subsidies that I think everyone is largely anticipating will come through. It's a matter of, how much more tariffs as opposed to whether there will be additional tariffs. I think that's a much bigger deal for the Chinese companies because they're really looking at the European market as one that they can crack. I think these moves by Biden may actually not amount to a whole lot in the sense that I think the Chinese companies have really sort of viewed the U.S. as not open to them, that they are not, even entertaining the possibility of going into that market. Even a company like BYD that has been really on a roll has viewed the U.S. as not an attractive market worth even trying to crack. Craig, at the same time, so Elon Musk says Tesla will spend more than $500 million on the supercharger network. So, I mean, is it surprising? This is something else because he put this on X as referring to it as a reiteration. This is not a figure that I've seen or heard out of Tesla. And it really smacks of in early 2019, there was this Musk move to close a bunch of Tesla stores, at least to try to. I think he did that very impulsively, realized that he couldn't actually close stores. His company was locked into leases. He had to kind of do a U-turn. This really feels like a similar sort of situation of damage control, of realizing that cutting almost his entire supercharger team
did not go over very well with his customers and just of lately his clients, in the sense that he's partnered with a bunch of other car makers to offer his superchargers. So this feels like a bit of activating damage control mode, if you will.
Even regret? Or is that maybe going too far?
I do think that he wanted to make serious make a serious message, send a message to the troops of, when I say I want to cut costs and be, in his word, hardcore, I mean it. And this really sent that signal in a way that was quite effective internally, even if it did some damage that he's now having to clean up after.
Craig, thank you so much, as always, for joining us. That was Craig Trudell, Bloomberg's Global Autos editor. Now joining us to talk about the markets, to talk about central bank action, Monica Defend, head of the Amundi Institute. Monica, as always, thank you so much for joining us. I mean, it's been quite a week. There were a lot of earnings, and now the pivot is really going to what Fed speakers and what kind of monetary policy we'll be left with in the U.S. What do you think will drive markets going forward?
It will be the central banks, as you were mentioning. We had today the GDP data on UK, so everyone is asking what the Bank of England will be doing. On that front, we believe that the ECB will start cutting in June, and later on we will have the Fed. So we will have the Fed delinking from the ECB, with all the consequences that this might imply on inflation and on the FX. The central banks, it is not in their mandate, but the FX consequences have to be seriously monitored.
Monica, I mean, I think you're still expecting actually a Fed pivot in the second half. We could have, that being supported by data, but the data has been all over the place. Or certainly the Fed promised something in December that they didn't go through it. Why has it been so messy? Is it communication or just a much stronger than expected economy?
I think it's the second one. So the U.S. economy proved much more resilient than anyone was thinking. Now what we see is real rates getting around 2%. So we do expect that eventually financing condition will tighten, and this will start eroding the consumption side. So this is where this slowdown will come from. Let's see next week's CPI data and the retail sales to have a more complete view, but we believe the Fed will start cutting it in July.
So, Monica, as there is more and more policy divergence, I'm thinking of Bank of Japan, but even maybe between the ECB and, of course, what we're seeing with the possible Fed, how do you play that in the markets?
Well, on the duration front, we remain quite flexible with a preference for the UK, in particular, the short end. We have positive bias towards the Treasury, and when it goes to the euro area, we are looking at the peripherals, in particular the BTP, while we are neutral on the euro duration.
Is there anything, Monica, that the markets are not really, constructive on right now where they should be? I don't know whether it's even concern on geopolitics, but it seems like quite a volatile market, but we also had a good earnings season.
Yes, definitely. What surprises me as always is this agnostic view and positioning on the geopolitical front. As long as on commodity prices, oil prices stay confined in a controlled range, the market seems to ignore what is happening on the geopolitical front. And if you look also at the election calendar, which is quite rich, I would say, for the second half, still the market is not taking any position. But as you were mentioning, earnings will prove to be pivotal. With this level of the market, valuations are quite expensive. Therefore, it is necessary that earnings do not disappoint.
So, Monica, what's your preference when you look at U.S. equities? Do you go for sectors? Do you stay away from the big seven?
Yes, it is very difficult amid this macro uncertainty and this level of valuation to have bold top-down stories. So we really do prefer to position within sectors in the UK market. In Europe, we are balancing quality and defensive. And on the US market, it is more on the equally weighted versus the market-weighted index. But again, it's more a bottom-up, let's say, this way market than a top-down play.
Monica, thanks so much. Monica Defend, of course, head of the Amundi Institute, stays with us, and we'll talk a little bit more about Bank of England and maybe some of the opportunities or not here in the UK. Now, coming up, some relief for the British Prime Minister, Rishi Sunak, as the UK economy bounces back from recession with stronger than expected growth. We'll talk about that next, and this is Bloomberg. Now, the UK has bounced back strongly from a shallow recession. GDP jumped to 0.6% in the first quarter compared to the previous 3 months, higher than forecast and the best reading since late 2021. Now, let's discuss all of this and what it means for the BOE, firing the starting gun on an easing cycle with Anna Andrade from Bloomberg Economics. So, Anna, let's start with the GDP data. Better than expected after a pretty shallow recession, but it's far from spectacular.
Yeah, I think the question now, I mean, it was 0.6%. We were expecting 0.4%, so it was a big surprise. And I think the question that everyone's asking is, like, is this the start of, like, a speedy recovery? And is growth going to be maintained at this current pace? And we don't think so. We're a bit skeptical. So we actually think that because monetary policy is still in restrictive territory, that's going to put a lid on growth. So the recovery will be broadly subdued. And what we saw in today's GDP data doesn't really change that view, mostly because when you look at the breakdown, you can actually see that a lot of the strength that we've seen in GDP was driven by net trade and by a fall in imports. And when you do look at the domestic demand, which is the bit that's most impacted by monetary policy, then it only grew by 0.2%. And it's still below its pre-recession levels. So in a way right now, you know, it does add the risks to the possibility that, you know, it will be a speedier recovery than we're thinking, but we don't have enough to sort of change our view that, yeah, it will be far from spectacular.
I mean, and it was really interesting. So we basically had the Bank of England yesterday, and he talked about market expectations, the governor. And it's clear that he thinks that the market has kind of been mispricing their willingness to cut, maybe because of what happened with the Fed, because they overpromised in December and then couldn't deliver through. The question is, once they start cutting, do they continue cutting? And Bloomberg Economics is quite bold with your prediction.
Yeah, we have like a cut at each meeting. And I think the way to think about it is that yesterday the BOE sort of signaled that it was uncomfortable with just 2 rate cuts. So we think that, you know, they probably think that 75, maybe 100 is sort of a little bit more appropriate. And that's even considering the fact that they have a pickup in inflation. So inflation will go down to 2% on energy, on the fall on energy prices. But then the BOE expects it to reaccelerate to 2.5% later in this year, going into 2025. Still in that scenario, they still think that 2 rate cuts are not enough. And so where we differ from the BOE is that we actually think that headline inflation will fall to 2%, but will remain there for most of the year. Sort of, it will pick up a bit, but it will remain broadly stable at 2%. And then we think the BOE will actually be surprised on the downside by the inflation. And that's when it will sort of get more evidence that actually it can go at every meeting. But a lot of it will depend on the inflation dynamics. Those are central to the, to the speed. Yeah.
So interesting. Anna, thank you so much. And Andrade there from Bloomberg Economics. Now, later in the show, we'll also bring you the interview with the BOE Governor Andrew Bailey following yesterday's rate decision. Still with us, Monica Defend, head of the Amundi Institute at, of course, Amundi. Monica, I mean, Anna was explaining there the view of Bloomberg Economics that actually once they start cutting, could be in June, they continue cutting. A lot of commentators saying that's dangerous because they probably didn't increase rates fast enough, and there's a danger now they're decreasing them too fast. What's your take?
We think that the Bank of England will start cutting as soon as June. More importantly, the market is really thinking that they won't do that much. We think they will do more. So whether it's 4 cuts, still we are above of market expectations, and this mismatch allow us to be constructive on the curve, in particular on the short end. When it goes to the readings that we do on the economic front, still on the manufacturing side, we'll see some weakness that is less evident on services. And when it goes to inflation, the direction is to 2%, but we are not sure that we'll get there. it will be something like a 2.3% on a 2 years horizon. So we're pricing in more cuts than the markets, and this is allowing us to be constructive on the fixed income in the UK short end of the curve.
But, Monica, why do you think, I mean, the market seems to be mispricing. And again, a lot of people, as you're mentioning, a lot of people think this is a communication problem from the Bank of England, or is it external factors in trying to read the data?
Honestly, the market in general, in reading all policy, monetary policy, is extremely volatile. I think what has happened on the Fed down to the ECB. So by no surprise, probably it might be related to the Bank of England rhetoric. I don't know. The truth is that we are struggling in reading the correct patterns and pathways on the macro prints. And the reason being that after the pandemic, there are some regime shifts in place that are really challenging our traditional approach to macroeconomics.
Monica, as always, thank you so much for joining us. Monica Defender, head of the Amundi Institute at Amundi. Now, we continue talking a little bit about some of the corporate news out there, and Sabadell has accused banking rival BBVA of breaching Spanish laws with its hostile takeover bid as tensions mount between the two lenders. Now, BBVA is seeking to buy Sabadell in an all-share offer that values a smaller rival at about 11.5 billion euros. Now, the Spanish government has said it will oppose the deal or the bid. Sabadell's board rejected the offer, saying it significantly undervalues the business. Coming up, the Israeli Prime Minister Benjamin Netanyahu strikes a defiant tone against President Biden in his first public comments since the U.S. confirmed it was withholding bombs from its ally. More on that next. This is Bloomberg. Now, the Israeli Prime Minister Benjamin Netanyahu has struck a defiant tone against President Biden in his first public comments since the U.S. confirmed it was withholding a shipment of bombs to Israel. Now, speaking to American talk show host Dr. Phil, Netanyahu says he hopes the two leaders can overcome their differences.
I've known Joe Biden for many years, so 40 years and more. We often had our agreements, but we've had our disagreements. We've been able to overcome them. I hope we can overcome them now, but we will do what we have to do to protect our country.
Let's now bring in Bloomberg Opinion's Mark Champion. So, Mark, thank you for joining us. The international cost, of course, to Israel of sending the IDF into Rafah is clearly rising, right, with condemnation from many, many leaders. What is their argument for continuing this offensive?
Yeah, it's interesting because they're being told by the U.S. and others that you're going to have whatever military gain you have here, it's going to be a strategic loss. The Israeli response is basically, everybody wants us to have some sort of day after plan in which there'll be an alternative authority and so on, and that can't happen. Nobody is going to send any troops into, peacekeeping troops or whatever, into Gaza, so long as there are 4 battalions of, fully formed Hamas troops still there with their commanders and everything else. That will be the nucleus for a reformed Hamas so that they can pose a threat to Israel again. So their view is that they have to do this militarily, and that no matter what anybody says, they just have to sort of bite down and do it, and then deal with the consequences and move on after that.
But, Mark, the U.S. position has basically been that the Israelis should not go into Rafah until they've moved civilians out of harm's way. So where are we on that?
Yes, I mean, this has been, the problem almost from day one of the war. If you recall, at the very beginning, before the land operation, President Biden, warned Israel, don't make the mistakes that we made in Afghanistan and so on. And so this has been a running sore where the U.S. would say, move civilians and do what you have to do. what we've arrived at in Rafah is the U.S. saying, was saying, move civilians before you do anything. Now they simply don't trust the Israelis to do what they're supposed to do. The Israelis have, for the first time really, made secure areas, bought tens of thousands of tents, put them there, and people are moving. The UN said that in the last day or so, about 80,000 people have moved out of the evacuation area that Israel assigned, sort of east of Rafah. But in fact, according to some satellite reports by Sky News, they estimate that rather more have moved. And it's not just from the evacuation area. In other parts of Rafah, people are moving already because they know what's coming.
Mark, thank you so much for the update. Of course, this is a story that we'll continue following very, very closely. That's Bloomberg Opinion's Mark Champion. Now, coming up, we talk China. Xi Jinping also leaving Europe later today with the firm backing of Hungary in their fight against the West's accusation of overcapacity. Details next, and this is Bloomberg. Now, President Biden is set to unveil sweeping tariffs targeting Chinese EVs and strategic sectors with an announcement possibly as early as next week. Britain bounces back from a shallow recession with the strongest growth in 2.5 years. Meanwhile, the BOE leaves the door open to a June cut. Plus, the Prime Minister Benjamin Netanyahu says Israel will fight on in Gaza with or without U.S. support as Washington threatens to withhold more bombs if Rafah is invaded. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So the Chinese President Xi Jinping has pledged more rail and energy investments in Hungary following his visit to Europe. Now, Beijing is counting on the Prime Minister Viktor Orban to push back against overcapacity accusation by other EU nations. Well, let's get the latest from Bloomberg's Piotr Skolimowski. Piotr, thank you for being on. Now, President Xi will wrap up his visit in Hungary today. How did it go and what did he actually achieve?
Well, obviously, it's this visit has been it's stood in quite a contrast to the visit in France previously earlier this week. And what President Xi Jinping pledged is rail and energy investment in Hungary. We're talking about investment to the tune of almost 10 billion euros, although that comes with all sorts of strings attached and loans, so it's hard to say exactly. We're talking about 18 agreements, and they are about rail, they're about energy, building various links. And what we are actually seeing which is kind of more controversial in that sense, there's also an agreement that will be signed with Huawei, where the national champion that Hungary has in telecoms is going to develop a joint cloud platform. So that's obviously one controversial thing. And as you said, what he won is obviously this pledge that Hungary does not identify with this description that EU is having for when it comes to exports from China, that there's an overcapacity. This is something that EU has raised several times. Here, Orban and Hungary has positioned themselves as a sort of a hub for EV investment in Hungary. We might, although it's not very clear, get another investment in another factory today. There's already one by BYD. Hungary is also a hub for battery production for the EU. So quite a chunky bit of investments that are coming from China to Hungary after this visit.
All right, Piotr, thank you so much for joining us. Of course, we'll continue watching the movements of President Xi throughout the next couple of days as he goes now back home. Now, Europe's electricity consumption has fallen by nearly 10% since a peak in 2008 due to shocks like the global financial crisis and COVID, as well as deindustrialization and slower than expected electrification. But what could change quickly? That could change quickly. That's according to a new research from Goldman Sachs, which predicts a surge in demand, in part driven by the AI data center boom. Well, for more, we're joined by the head of European Utilities Research at Goldman Sachs, Alberto Gandolfi, who's an author of the report. So, Alberto, thank you so much for joining us. I mean, this is a fascinating report because it basically really puts electrification, especially of Europe, at the heart of this new AI revolution. Are we ready if we have more AI, more data center, for how much more electricity we will consume?
Simple answer, and thank you for having me. No, we're not ready. We're not ready because energy transition in Europe has largely focused on developing wind and solar capacity, and it's been quite successful at doing so. What has been neglected is the power grid. And this is fascinating because data by the European Union and Nexans suggests that the EU grid is the oldest in the world, 45 to 50 years old. So we are almost reaching a crunching point where we need to very, very quickly step up investments, particularly in the medium-low voltage power distribution. And we think some regions have understood that. We saw recently E.ON essentially talking about doubling in capex in its power distribution investments in Germany, for instance. But this creates a challenge because not only investments need to go up in Germany, but in every single European country. And the United States are going through a very similar path. So this is going to create pressure on the entire ecosystem, on the entire supply chain. And it's fascinating. And so power grids be beneficiaries, even renewables.
But also in your survey, I mean, you say that, you know, the power consumption could increase, I think, between 40 and 50%. I mean, that's a massive amount of extra electricity that needs to be generated. And I think the time frame you gave for that in the next 3 years. So even if we ramp up, even if officials, companies, politicians force this, we'll never, or will we be able to achieve that in 3 years?
Well, let me be clear. I think in 3 years, we are going to start to see unequivocal evidence about this pattern. We think 40, 50% is a 10-year development. But 10 years is relatively quick in energy market. You know, it takes 3 to 4 years to build an offshore wind park. It takes a year and a half to build onshore. And sometimes permitting is anything from 2 to 7 years. Even grid permitting is very long. So we are already falling behind. And I think actually electrification and data centers, as you correctly said, are the big drivers here. And 9 months ago, 6 months ago, nobody was talking about data centers. And data centers could imply a boost to demand twice as big what we're going to see from electric vehicles. And it's starting right now. So this is why we think that, yes, it's feasible on a 10-year basis, but we need to start now that power demand is not, quote unquote, rocketing yet. Because once you start to see power demand go up 4-5% per year, which probably is 27, 28, that would be way, or 26, that would be way too late. Yeah.
But Alberto, I mean, some of the conversations that also need to be had is that, you know, getting electricity up, fine, but it depends also on the source of electricity. So if you get electricity through, you know, fuel that's not considered green, then it also will make it harder to wean ourselves and do the transition. So where do you think that the main extra power grid will come from?
But it's a great question. I have to say that because the nature of the clients that require this incremental electricity, you know, the big four, you know, the Microsoft, the Amazon, you know, Google and so on, and Meta. So essentially, those companies have very strict green targets. So they will want a big share of this incremental demand to come from clean sources, which could be wind, solar, could even be nuclear in certain regions. That's particularly the United States, I would argue. But gas needs to be a transition fuel, as we've been arguing for a while. There are several regions in Europe, Spain is a key example, where there is a very large oversupply of gas plants. So we actually think that several countries in Europe are ready to step up production because we are starting from an oversupply situation, Spain or Nordic. This does not apply to Germany. Germany has to build very quickly, not only renewables, but gas plants. The government is about to auction 15 to 20 billion euros of gas plants that need to be built by 2030. And if these auctions don't happen this year and next year, there's a chance that Germany will already fall behind. So again, it's a race against time, and it's not just clean energy, it's also backup, because particularly data centers require electricity nearly 24/7 for cooling, for processing the data, for transmitting the data.
So Alberto, talk to me a little bit about what that means for stocks. I know you say you favor these electrification compounders. So what are those? They're companies that you like.
Yeah, electrification compounders are utilities that sometimes in capital markets are considered as dull bond proxies, then just move with interest rates. This couldn't be further from the truth right now. We are probably at the eve of a generational growth in earnings that the market is completely underestimating. So what are the stocks that we like? There are stocks that have big exposure to power distribution activities that we expect to grow high single digit to low double digit per year between now and mid of the next decade, so in the early 2030s. And those stocks sometimes tend also to develop renewables, which will also benefit. So if you look at a company like E.ON, where 65% of EBITDA is power distribution, in a country largely like Germany, which has completely understood this issue, well, that's definitely a key beneficiary. Other stocks of a similar nature include Enel, SSE, or Iberdrola. Those are the electrification compounders. Then we should put a second group of stocks that are also going to benefit from this. The stocks that develop renewables, the stocks that maybe have a portfolio of power to offer, RWE, Ørsted, EDPR. And those stocks right now price in zero, or in the case of RWE, negative value for future renewable growth. So this is a very big opportunity, potentially at the eve of rate cuts across Europe by central banks, with this structural, secular, organic growth that is going to be independent from any economic cycle in a way, that actually puts these stocks in a very good position, particularly these electrification compounders we talk about. They trade on an average P 2 years out of 10 times. The 20-year P average, so the mid-cycle P average over 20 years, is close to 15 times. That discount doesn't make any sense given the organic growth we see ahead.
Alberto, thank you so much. Alberto Gandolfi, their head of European utilities at Goldman Sachs, with an interesting report out this week. Now, coming up, our interview with the BOE Governor Andrew Bailey, who indicates that markets are underpricing the pace of easing in the months ahead. This is Bloomberg. Now, the Bank of England has sent its clearest signal yet that rate cuts are on the horizon, with Andrew Bailey indicating that markets are underpricing the pace of easing in the months ahead. Now, the BOE governor spoke to us yesterday after, well, the 7-2 vote to keep rates on hold.
Our forecasts are conditional on a number of things, but one of the things that obviously are conditional on is we use the market curve to set them up. So I think it's important that if we find that a forecast with the market curve produces a best judgment, which has inflation below target or above target, wherever, but not at target at the sort of horizon, we say so. We say this is where we got to. Best collective judgment is that. Now, it follows, I think, that, and this is the comment I made earlier, that what we're saying is if, and the if is of course critical here, if the world evolves as that forecast suggests it was, well, probably the case would be there for a less restrictive path of policy.
So is
it's
June
all conditional?
Everything's conditional. Is June a live meeting?
All meetings are live.
So is June likely?
That's a different question. That's different. Look, I think the key points I would make is that we have changed our view on the likely persistence of inflation, on the second round effects. And it's good news. We think there's evidence there to suggest they will be less pronounced than we thought they would be. But that's a judgment, and for me, I'm now looking at particularly these three key indicators: services inflation, pay, and the quantity side of the labour market, to really judge this persistence question, how it will evolve.
But Governor, because you were quite upfront about market expectations, does that come from Ben Bernanke's review that you will talk more about the markets to indicate more to the markets also what you're doing next?
Well, we're not going to implement the Bernanke review piecemeal. So we're obviously going to spend a few months really sort of thinking quite hard about what we do. And he raised the conditioning assumptions as a point actually, and this question which I think all central banks wrestle with in various ways, which is how do you actually sort of represent a future profile of rates to set up your judgment without sort of getting yourself into a position where you're absolutely nailed on, as it were, for a view of rates 2 years out, which of course is just not realistic to commit to.
But can we expect more market commentary from you going forward?
Well, I think we're in a particular situation at the moment. I've said before, it's a high bar, I think, for us to sort of come out and comment extensively. But I think the point we've made today, and I think have to make, is look, quite a lot of them, when we do the analysis, quite a lot of the market movement of late appears to have been US, in a sense, originated. Now, there's always some of that, of course, but there seems to be more of it. And yet, our analysis would be that inflation dynamics here are different to the inflation dynamics in the US. We're in a very different sort of situation in terms of our economies. So there's a tension in there, and I think that's the point we have to point out.
But this is basically because the Fed maybe overpromised the cuts in December and then couldn't deliver in terms of 2%.
Well, I'm not criticising the Fed in any sense or judging the Fed. I think the US economy has evolved. I mean, that's the fact. I mean, that's how it's evolved. So I think the way it's evolved has been, if anything, to sort of put in a slightly starker relief the difference of inflation dynamics.
Governor, are you worried about the second round effects of a cheaper pound?
Well, I mean, the exchange rate hasn't moved sharply, frankly. It's moved a bit, and of course you'd expect that because it's a relative price. So this point I make about different inflation dynamics, you'd expect some, but it hasn't moved sharply. So no, I'm not. We watch it very carefully, but it's not something that. And by the way, as we said, as we always do, in setting up our commentary on the conditioning assumptions this time, actually the exchange rate hasn't moved that much.
Governor, there is an assumption, looking at history, that once you cut, you continue cutting. Now, without prejudging what you'll do, can you give us an idea of how you see the cycle different to 2009?
One thing I would say about this, which is sort of quite interesting, and it's something that we looked at during this round, it's quite interesting in the history of the MPC that most of the cutting cycles in inverted commas, have actually been prompted by some sort of shock or other, rather than being what I might call a natural cyclical sort of, we've reached the top and now we go down the restrictiveness curve. So we don't have a lot of, I would just caution, there isn't a lot of sort of history really to.
So what you're telling us is because you're not cutting in a recession, it could actually be one and done?
Well, I think that would be unusual. But I would say, as I said earlier, nothing's settled, there are no fait accomplis, nothing's ruled out.
Governor, what can you tell us about the play between, of course, interest rates and QT? Right. Some may find it confusion because they're pulling in different directions.
So the message we've always given with QT is that QT operates in the background for us. We don't think it has large impacts in terms of markets. But the other point, and this is really the critical point, when we sit down to decide on what the right interest rate setting is, we take into consideration everything, including markets, obviously, and markets will have absorbed, if you like, and taken into account the impact of QT. So, in other words, QT is always there, if you like. If there is any effect from QT, we'll capture it because we'll capture it in the movement of markets, and then we will set bank rate to reflect that.
But you don't think it's confusing for markets, this kind of pull?
I don't think so, no. Don't think so.
So you're not expecting it to end it before the end of the year to make sure that there's no confusion in what you're trying to do with the economy?
I don't think there is, to my mind, any difficulty if we get to the point when we're going to cut interest rates to have QT going on as well.
Well, that was the Bank of England Governor Andrew Bailey talking to us yesterday. Now, coming up, IAG reports strong summer travel demand in Europe and across the Atlantic in its first quarter results. More on the numbers from the owner of British Airways next, and this is Bloomberg. Now, the British Airways parent IAG has reported summer travel demand is strong in Europe and across the Atlantic in its first quarter earnings. Now, let's get more with Bloomberg's Sid Phillips. Sid, I mean, this is an amazing story because basically a lot of people, me included, book well in advance for their travel holiday. So what does it tell us about the bright spots for the travel industry going forward?
So British Airways is obviously focused on transatlantic travel, and IAG, the broader group, which owns Iberia and Aer Lingus, is also focused on Latin America. And so they've seen a lot of demand for travel into those places, as well as intra-European travel. And I think that sort of shows that people are still sort of resilient in terms of booking their holidays. And essentially what will be key is fares and where fares go in terms of determining profitability. I mean, summer is the most important travel season for the airline industry. And so essentially this is crucial for them to make their money. And they seem to be more bullish about the prospects than the rest of the industry.
So turning to Boeing, because you cover a lot, turning to Boeing, why is the SEC now looking into the statements made by the company?
So the SEC at the moment is looking into statements made by Boeing in the aftermath of the Alaska Airlines incident when the door plug blew out on the 5th of January. And they're looking to see if Boeing executives made comments that potentially misled investors. Not all SEC investigations result in any sort of charges, and it could well be that there's nothing there to be seen, but it is significant because they're looking into Boeing's conduct essentially in the aftermath of that incident to see what really went on there.
Sid, as always, thank you so much for joining us. Sid Phillip there with the very latest, of course, on all of this news out there when it comes to travel and planes. Now, Formula E is now in its 10th season, and as the sport grows in popularity, questions are being asked about the championship's carbon footprint and net zero targets. Now, for more on this, let's go to Bloomberg's Oliver Crook, who's at the Formula E circuit in central Berlin. Ollie, good morning. You have a pretty good gig, so you spoke to the chief executive ahead of another big race. What can you tell us?
Yeah, that's right, Francine. So we're at the Tempelhof Airport here. This is really a 1920s airport here in Germany, but really today containing the future of racing, potentially in Formula E. We've got the race that's coming up tomorrow and over the weekend. As you can see, all of the car companies here that are preparing their cars. This is the Cupra team here behind me. And yeah, speaking to the CEO really about this business and thinking about this business, this is only 10 years old, Francine. So there are a ton of challenges for this business to try to overtake, say, Formula One that has literally billions of dollars in sponsorship, an absolutely huge fan base, but there's also a huge opportunity. I mean, the technology in these cars is changing so swiftly. The new generation of these cars is going to be 30 seconds, is going to be 30% faster. And so I talked to him also about attracting new car companies and trying to get the Chinese players into Formula E. Have a listen.
Absolutely see a BYD team. I could see a Geely Group team like Lotus or Zeekr, SAIC, who obviously own brands like MG across the... So absolutely I can see a Chinese team. We actually have two Chinese teams here. We have ERT, but we also have Envision.
What about a Tesla team?
I think Tesla's unlikely, and I'll tell you why I think it's unlikely. So all of the teams here are racing on a common battery. So I'm not sure that Tesla would be so keen to run on a battery that isn't their own.
And Francine, the other reason he said that there probably won't be a Tesla team, because if they're new to the sport, they'll probably lose. Never maybe a good idea to challenge Elon Musk quite like that.
Never a good idea. That much we all know. Or maybe it's a good idea. Ollie Crook there at the Formula E circuit in central Berlin. Well, Bloomberg Brief is up next, and this is Bloomberg.